Hello, everybody. Hope your day is going well and your week's off to a good start. Today, we're going to continue going through the funding playbook. So, as always, you're here in the community, go to classroom, funding playbook. All right, scroll down to the bottom, click on the PDF here, open that up. All right, so today we're going to be going over funding qualifications. So, this is a very big reason why people sometimes have a misconception and the expectation to get funded a lot more than what they could actually qualify for. I know this page here, it's a lot of information. I'm going to try to break it down for you into bite sized chunks. Main thing here is we just, in simple terms, trying to break it down into four main different categories. And so you can use this information to try to, categorize yourself as best as possible. It's sometimes pretty hard to do that. That's why there is a lot of variables that need to be taken into account when figuring out where you actually fall. But let's just start over here. So tier four, this could be again anywhere getting typically funded between 50 to 75,000. That number could be lower. It could be right on the mark. It could be more. It just depends on a number of factors. But this would be for businesses that are brand new. They don't have any years in business. They don't have any company financials. Like you just set the company up 2 weeks ago, a month ago, something like that. Ideally, obviously, you want to have some cash on hand. We'll get into why that's a good thing to have here in a minute. Tax returns typically, obviously, not required funding here. Obviously, you don't have any business tax returns. Having personal tax returns, personal pay stubs, that can always come in very handy, and sometimes that is requested by the lender when trying to get approved. No P&L statement, obviously. Average credit, so that means right here, average credit limit. That's typically saying like what's on your, personal credit file. Is your largest personal credit card limit? Is it 5,000, 8,000, 15,000? So typically here, tier four, you're ranging anywhere from like a $5,000 to $10,000 highest personal credit card limit. Available total personal credit. So this is if you add up all of your personal credit card limits together and combine those limits, not the balances, just the limits. Um, right here, you're looking at, at least 25,000 is a nice place to start. So that means maybe you have half a dozen different personal credit cards over the past, 5, 10 years or so that you've accumulated, whether you're using them or not, doesn't really matter. They're adding age and history onto your credit. So you might have, a $10,000 card, a $5,000 card, and then maybe a couple other cards, a couple $1,000 a piece. Um, and then average credit age. This just means if you opened up, let's just say a card 10 years ago, and that's the only card that you have, your average credit card age is going to be 10 years. If you have a card that's, 10 years old and you just recently opened up a new one, your average credit card age will be about 5 years. So a good sweet spot, 3 to 5 years of age, that's really, really good. That again just shows creditors, lenders that you have a history of managing your finances, um, responsibly. This is someone who's younger and they don't really have any mortgage history, auto loan history, mortgage, auto loan, personal loan history. Those are all installment loans. So that buy a vehicle, or it might even be an unsecured personal loan that you're using for home renovation, debt consolidation, whatever that may be. Has a set term. So it has, say, a 3 year or 5 year, 10 year, whatever that term is. And you have fixed monthly payments, fixed interest. And once that loan is paid off in full, it closes on the file. It still reports as a closed account, but it closes. So this is what you could expect for, like a tier four, again, 50,000 to 75,000 in funding. Again, if your personal credit file doesn't have anything negative on it, you don't have any late payments, you don't have any collections or anything like that, you could expect to get funded, roughly that amount. Now, if we skip here, over these next two, we go to the tier one, what does that look like? So we would categorize, a tier one client to be someone that they have a business that's fully established, right? You have time in business, you have company financials. It's probably not just yourself working in the business. You probably have some other employees, maybe a business partner, um, and you're cash flowing, a couple $100,000 a month, right? So meaning, you're doing a couple $1 million a year in top line revenue. Your net profit's probably a couple $100,000. Business is doing well, and so when the bank, asks for company financials, P&L, debt schedule, tax return, you can provide those. That obviously leads to much larger amounts of funding because, like we spoke about on the last video, with just the foundation of what is business funding, what do banks care about? They care about that deposit history. They care about the cash flow, money coming in, money going out, and obviously you have more coming in than you have going out. You're setting aside some, whether that's in a reserve account, a reserve checking account, or maybe even like a savings account, but with that same bank, building that relationship. Cash on hand, probably have at least $250,000 in cash on hand. Again, that's from the reserve that you've built over time. Maybe you've had some big deals that you were able to get done, and you set that money aside, not just for operational expenses, but just to use as leverage when trying to get more funding from the bank or from even private lenders. And I forgot to circle back earlier. So yeah, the cash on hand is important because when you're going out and you're applying for funding and you're setting up new relationships, you're setting up a checking account, maybe a savings account as well. You work with a relationship manager. You want to be able to make a nice deposit. You do. Sometimes they say the minimum amount to deposit is $100, $200. You don't really want to make the minimum. Obviously, if that's all you can do at the time, it can still work to a certain extent. But the more that you can show with a brand new relationship of actual money in the bank, that means a lot. The bank, they care about that. Some banks, they actually have a threshold to where they won't even open up the opportunity to you to work with a relationship manager to help process an application unless you have six figures in the bank with them. So if you open up that brand new relationship and you only have 30 grand to put in there, that's great. You can still apply, but you can't work with a small business relationship manager. Whereas if you had, $100,000, $200,000 to drop into that account, even temporarily, put it in there, let it post. Now that opens up the door, work with the small business relationship manager, submit the application, get approved for the funding that you need, receive that funding, start using it. You can move that money and reallocate it back into your, parent bank or the main location where you operate your business from. But cash on hand, it definitely can go a long way, and that's one of the reasons as well why we always recommend set aside at least 10% of all top line revenue aside into that savings account for the bank rainy day fund. More times than not here, trying to get larger amounts of funding, business tax return, personal tax return, more than likely, the most recent 3 years is what they're going to request. And then if you have any business partners as well, you want to keep that in mind. More than likely, they're going to need to provide their tax returns as well, and their credit also might get checked. So one loophole that you can use is on the operating agreement, adjust your partner's ownership of the company. Or maybe it's not yourself, maybe it's a different partner that you have that has better credit history, higher score, and you want to use their personal credit file for getting funding. You could temporarily on paper move majority ownership to them. They get the funding, and then you can go right back into that operating agreement make the adjustments back to where they need to be, sign, date it. It's a very easy fix. And if the lender asks for, hey, proof of ownership, you provide the operating agreement and it shows all those details, you're good to go. There's no changes that you need to make, at the state level or anything like that for the company ownership. And then here, average credit limit, you're looking at, a very large amount, right? You've probably an older individual that has built really good relationships on the personal side and over time has requested credit limit increases or have gotten approved for very large limits with banks. And so that obviously will allow for larger amounts of funding because you've shown on the personal side that you can manage a large amount of available credit and you've used it responsibly. And obviously here, account age, and a mortgage history, auto loan history, personal loan history. So you're established, right? You've purchased properties, maybe you've sold properties, maybe you have multiple properties, you've had vehicles, you paid off those auto loans in full, you have new ones. It just shows that, again, someone over here in a tier one, probably a little bit older, more established, probably married with a family, has lived at least at one location, if not multiple, own those properties, has a company that's been around for a number of years, and has stabilized the situation. Whereas over here, brand new scenario, younger individual, no company history at all. So this essentially goes from tier 4 is the highest risk to the bank. Tier 3, a little bit lower risk. Tier 2, a little bit lower risk. And Tier 1, the lowest risk, right? So that's why over here, Tier 1, you're looking at getting a very large amount of funding because you're in a much lower risk category in the lender's eyes to get that funding. And on Tier 4, you're a bit of a higher risk because you're a bit more of like a wild card, right? The lender, the bank, they just don't know what to expect yet because you don't have the track record of your company's performance to sustain large amounts of funding and being able to prove that you'll be able to pay that debt back. So hope that was helpful going over these funding qualifications. As always, if you have any questions at all, leave a comment. If you know anybody who would benefit from this information and learning more about business funding and how it works, please invite them to the group. We'd love to have them part of the group. And yeah, I'll see you on the next video. Have a great day.